So we know there's going to be the migration of money into Southeast Queensland, and we know from an investment perspective it's going to be put on the world stage. And of course, that means certainly money will continue to flow into Brisbane, and where money flows, real estate grows. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, code cracking stuff. We're going to dig in how and where to invest. Yes, we're going to tackle what's going on. Where should we put our money? We're going to learn about one concept in real estate, which I've always thought is one of the best, the migration of money. Where should we migrate our money to? How do we know what makes the right migration of money strategy? Today's show is all about that. And yes, now it's time for my shameless plug around my book, The Australian Property Game. Yes, have you read The Australian Property Game? If not, you should. It's the playbook when it comes to being a property investor in the Australian property market. There is so much to learn in here. There is all sorts of different concepts, whether it's learning about oligopoly markets, whether it's learning about innovative and competitive real estate marketplaces, the auction clearance rate, what that means, tips for being a good landlord, how to understand tax, and of course, the margin of safety when it comes to property investment, and what that actually means. The short-term property cycle, the long-term property cycle, pricing power, parity, it's all in the book. How do you get the book? I'm glad you asked. You simply go to Amazon and you buy it. You buy it off Jeff Bezos. Yes, he is not rich enough. So you give him $22 and you get a book the very next day, arrive at your house, sometimes the same day. It's amazing. He really does have an amazing business. The book is printed on demand, so you just go to Amazon. It originally started as a bookstore, and my book's there, The Australian Property Game by Sam Saggers. Anyway, that's it for my shameless plug. I think maybe that will be the last time I try and plug the book. I don't know. I've done 4 plugs in a row now, and I've probably sold 4 books. So maybe that's the ticket. Every week I can sell a book and get paid $1 from Jeff Bezos. That's my wealth creation strategy. But hey, we're not here to hear me grovel and whinge. Let's talk about real estate. Let's talk about investing. Let's talk about the migration of money. I think it's a good, worthy conversation. How and where to invest. So first, I think we need to discuss the concept of the migration of money. The migration of money is simply that Australia is not one property market. It's multiple property marketplaces. And within those multiples, there's even more property markets. And of course, that means you can migrate your money from a suburb to another suburb. That means you can migrate your money from a capital city to another capital city. It means you can migrate your money from a capital city into a more feeder-based regional community. Money is always looking for a home, and in real estate, it is no different. Really, the idea of where money flows, you often have the concept real estate grows. And really, that's led off a principle in real estate known as following aggregate demand. Now, there's all sorts of ways to follow aggregate demand. Quite often, where there are finance approvals, you can often follow a high level of finance approvals into places whereby aggregate demand wants to shop. But ultimately, the migration of money is pretty simple. As I kind of alluded to, Australia is made up of multiple marketplaces and multiple states and territories, and they all have different rules and they all have different tax systems. Ultimately, inside of our state government systems is land tax. And of course, land tax, a little nasty tax that if you end up building a creative, beautiful property portfolio inside of one state, you may end up in a position where as that real estate grows over time and it becomes more valuable and the land goes up, that you're slugged with penalties for designing a portfolio like that. So we've kind of always taught, like, throw your money in different diversified places, particularly from a state level, so you don't end up in a place where you are responsible for paying large amounts of land tax. And of course, what that could look like, just to visualize it in your mind, is a property in Sydney, a property in Newcastle, a property in Brisbane, a property in Melbourne, a property in Adelaide, property in Perth, and you've diversified outside of just one state. You've got multiple states working for you. And of course, the migration of money not only helps you minimize land tax, generally in Australia, property markets move at different speeds. Sydney might be stuck doing nothing, and all of a sudden Brisbane's doing something. Brisbane may be stuck doing nothing, and then Perth's doing something. And of course, Perth might have the most fastest rate of growth going on inside it, and eventually that stops and somewhere else begins. Really, that is the concept, that if we can follow from a portfolio creation point of view, a next cycle, we can get with it a price lift arbitrage. Now, obviously, there are cycles which are doing very well at the moment and marketplaces which are doing very, very well, but you have to question whether you're too late to the market cycle, and or do you really want your retirement in real estate designed around that marketplace despite it going up in value? And this is where you need to decide whether you're going to do something for the short or long term. And there's nothing wrong with going to a market, watching it go up in value, migrating money into that market and getting in and out in a short period of time. Obviously, when you do that, you have to have the mindset that you've got big holding costs on the way in, or big purchasing costs like stamp duty and legal fees and so forth. And you've got big sales costs on the way out, things like, real estate agent fees, capital gains tax, and so forth. So being a bit of a property trader can work, but you really need the market to well and truly push above a 30 to 40% capital growth rate in a very, very short period of time. And of course, no one has a crystal ball. So, for a lot of people, that strategy is, it's not, you can't foresee it to be the right strategy. Hence why a lot of property experts would never suggest to become a trader in a volatile marketplace, because of the risk adjustment against the what if something else unfolds and you get lumbered and stuck to a property market you don't want to be in. And I've certainly seen people get the lashes on the back for that one. You could go back to the famous Moranbah, a marketplace which was surging in value in Queensland. And then all of a sudden, everyone thought they were genius at buying in that marketplace, and the market direction changed. The fundamentals of the market fell away, and all of a sudden, everyone was caught in a marketplace which plummeted in value, and they'd paid way too much for the real estate, hoping the market would continue to do its thing. So it's very important to migrate your money to the right places. And as I alluded to, the migration of money is, it's a pretty simple formula. Like, we work out what's popular and we go there and we put our money in that marketplace. Now, that may also mean selling up in a property market which isn't a popular marketplace. Perhaps you've owned a property for 10, 15 years. It's done its thing. It's gained in value. The migration of money is really also the concept of going, okay, I bought this property for $650,000. Today, it's worth $1.4 million. Is that real estate actually going to go from now $1.4 million to $2.5 million? When is that going to happen? How long would that take to happen? Is it actually a likelihood it would happen? Or really, when you analyze the local market factors, do you see that really it's done its best it can through the past cycle? And the future cycle for that kind of real estate is circumspect, meaning it's very, very difficult to understand whether a higher income bracket is going to come into that suburb and push values up. Where is the growth going to come from is really the question, and how is it going to come? Or really, has that cycle and that marketplace reached its maximum point of maturity? And really, the future is a lower rate of growth, meaning that $1.4 million property, which started out at $650,000, it might end up at the next cycle at the next 15 years as a $1.7 or $1.8 million asset, but it's not going to end up as a $3 million asset. So then the question arises, well, do you migrate your money? And of course, for a lot of people, they don't need to sell down assets to migrate money. They just recycle equity from the gains they've made from real estate, and they go find a home for it out in the marketplace. Other people, though, do need to go, well, is the best now done for this asset? I've made a huge significant gain. Can I get a rate of growth faster somewhere else, which will compensate me for the sale fee and the capital gains cost? But the likelihood of that real estate going from in a new area, 1.4 to 2.5 is just higher. It's going to happen. And really, obviously, there's some residential market research you need to be able to do to kind of pinpoint whether that's actually probable or not. But assuming it is probable, really the idea is we move our money around and we change real estate tact. We pivot. We do other things with our hard-earned wealth. And of course, you can change asset type. You can migrate your money from an apartment to a house. You can migrate your money from a house to a luxury home. And really, the ultimate place to end up is a piece of real estate which has no ceiling. So you don't need to ever migrate out of that real estate. And really, there are some pockets in Australia where real estate is so valuable that it really has no ceiling. I was at a National Australia Bank event the other night, and I was looking at the tier one luxury end of the real estate market. I do some work in the tier one luxury end of Australian real estate, mainly in sort of the project space. But what was interesting in Sydney in 2025, there's been 177 sales, over $10 million. And if we were to look at a property where really there is no ceiling, I wanted to sort of mention it because I thought it was pretty outstanding. 96 Victoria Road, Bellevue Hill, Sydney, sold in June 2021 for $30 million. Just resold late last year in November for $42 million. No ceiling. There's no ceiling. That $42 million property could become a $52 million property. And again, I know they're big numbers, but the same concept works for the rest of us, us plebs at the bottom of the market who aren't buying $42 million real estate. So where can you migrate your money to? And I think it's a worthy conversation to understand that obviously we can go from a marketplace which is full of action to a marketplace which is actionless. And we can start to go, well, let's follow the marketplaces which have less action and move our money from marketplaces where the action is reaching its peak. And really that's kind of the concept of Australian real estate. Now, I'm a big believer in sort of two marketplaces at the moment for two different reasons. I think the Brisbane market has a defined time horizon around the 2032 Olympic Games. We know that there will be money migrating into the Southeast Queensland economy. We can use evidence based from other Olympic cities to track what happens as you get closer and closer to the games and what happens primarily to the real estate marketplace. Obviously, when you're building an Olympic city, quite often some of the challenges is the builders inside an Olympic city have to down tools on residential buildings of properties and build and renovate a city. We do believe that will be the case for Southeast Queensland, for Brisbane. New stadiums, new transport nodes, upgrades to just about everything. Think about just some of the crummy hotels in Brisbane where they're overdue a renovation. All of a sudden, all the builders will be working on those type of jobs rather than knocking up houses. So we know there's going to be the migration of money into Southeast Queensland, and we know from an investment perspective it's going to be put on the world stage. And of course, that means certainly money will continue to flow into Brisbane, and where money flows, real estate grows. The polar opposite for Melbourne, but Melbourne has the unique advantage today of being a very affordable marketplace when compared to its peers, Perth, Adelaide, Brisbane, and Sydney. And of course, when you're doing the quintessential migration of money, you're going, okay, well, I've just made a lot of money in Adelaide. Do I really think this property I bought in Adelaide for 600,000 that's worth 1.2 is going to be worth 2 million in the next 10 years? Well, no, I don't. I don't think that anymore. I'm from Adelaide, and I know everything about Adelaide. And I'm not personally from Adelaide, but I'm method acting that I'm the Adelaide owner. So then you go, well, where's good value? And you migrate your money, create some equity out of the property you own, perhaps. You migrate it into another marketplace. So here's some pretty cool statistics about the Australian money markets, the real estate markets, and the migration concept of money. If we were to look at REA Group Residential, Australian Bureau of Statistics source around effectively who's shopping where, the change in number of loan commitments, not including refinances, we can see 23% of investors are buying in New South Wales, only 10% in Victoria. We can see 26% in Queensland, 22% in South Australia, and 36% of investors are buying in Perth today in Western Australia. And we can see from that data that investors don't believe in Melbourne, and you're not getting price growth in Melbourne right now, which is interesting because we can see that that's going to cause a price delta where all of a sudden Melbourne looks like very good value, very good value. Conversely, because everyone's in Western Australia buying, it's going to push the market up in value. But if we go to a buyer sentiment survey done by REA Group, we can see if you asked people today, is it a good time to buy in Perth? 19% of people believe it's a good time to buy in Perth. 53% believe it's a terrible time to buy in Perth. Conversely, if you follow this sentiment survey, and sentiment's a big driver of the migration of money, in Victoria, in Melbourne, is it a good time to buy? 40% of the market believes it's a good time to buy in Melbourne. 23% believe it's a bad time to buy. And then if we went to Queensland, good and bad, good 31% and bad 36%. New South Wales, good 34%, bad 25%. South Australia, basically good 34%, bad 35%. But what really interests me is the migration of money from Western Australia to Victoria. Now, you can go back to the previous cycle whereby Perth skyrocketed in value. It really was a long time ago. It was back between sort of 2003 up until around 2007. And what happened was the market went up, doubled in value. I was an investor in the market, as was many other people. What we did, we migrated money out of, at that time, a roaring Sydney market off the back of the Olympic Games. We took it over to Western Australia and we got massive, massive growth. And then we recycled equity. And where did we go? Back in 2007, we went to Melbourne because Melbourne at the time was full of value. And really, sometimes these things repeat themselves because it does seem to me that all of a sudden, if you did the price delta between Perth and Melbourne, it's a lot more value in Melbourne than there is in Perth, though right now there's a lot more demand in Perth than there is in Melbourne. So owners that believe it's a good time to sell. If we went to Perth, 56% of sellers say it's great. I'm going to sell. I'm going to capitalize on my money. I'm going to get out. And you can see it right there from the data. If you go to Melbourne, is it a good time to sell? No, it's not. 14% believe it's a good time to sell. So terrible time to sell your investment in Melbourne. Great time to sell in Perth. And what would happen? Well, you've made money in Perth. You go to where the weakest market is at a capital city perspective, which is Melbourne. So you take your good money from Perth and you take it into Melbourne. And really, that is the migration of money. That's what happens from an economic point of view. And it's interesting, very interesting. I heard Dr. Andrew Wilson talk about this with his rolling daily index on the My Housing property market. And he was saying he'd seen the first couple of months of Melbourne going up in value. And so I cross-referenced that against an SA4 prop track report on, basically Melbourne. And interesting enough, over the last quarter, not the last year, the last 3 months, the Melbourne inner ring of Melbourne has done 5.9% capital growth. Now, annualized over a year, that's basically 1%. But the point is we're seeing some signs that the migration of money is lighting up that marketplace. And recently, the Herald Sun just came out with a report or an article, and it's the classic clickbait nonsense, but it said Melbourne's property market is on like Donkey Kong, $250 a day. Herald Sun, $250 a day. So the market now is moving. Are we seeing the first signs of the early adopters migrating their money out of other places into Melbourne? It would appear from the data that that could be the case. Now, again, when you think about real estate, you've got to think about the most important factor is the rate of growth. The rate of growth is important because it determines how long something takes to perform in its value proposition. A high rate of growth, 7%, a property could double in 10 years. A low rate of growth, 3%, a property would take 22 plus years to double. So this is where the migration of money really helps the rate of growth. Now, if we migrate our money into the right territory, being the right city, the right state, then we've got to go to the right place. And that is a really important factor to get the optimum return on real estate. And really, I call this the golden arc of real estate. This is the migration factors that are truly important when it comes to where you put your money at a localized level. Local factors will determine the rate of growth. The golden arc of migration is once you get to a place, now it could be Perth, it could be Brisbane, it could be Sydney, it could be Melbourne. Once you get there, the golden arc of really where the big money migrates into. And if you can find the right real estate at the right price, you're going to win. The first one is green suburbs, leafy suburbs. Basically, they perform really, really, really well. These are your quintessential green belt neighborhoods. They absolutely will get money flowing into them. The next one is the blue space neighborhoods, areas connected to the water, whether it's the suburb right on the beach or one back from the beach. They are going to get a lot of migration. Why? Because of lifestyle. Remember, as real estate markets go up, people also create equity in their own home. They can buy and sell in the same city. Their house all of a sudden is worth more, so they go looking for a better house. And where are the better houses? Well, they're all in the lifestyle precincts. And this is why I call it the golden arc of real estate. And of course, an arc is that kind of concept, Noah's Ark. You get in it and you're bulletproof. So green suburbs, tree change, however you want to phrase it, they are bulletproof. Blue suburbs. I was at Tier 1 Luxury Talk by NAB last night. Brand new real estate on Manly Beach is now $77,000 a meter. A meter. That's crazy. Manly Beach is a lifestyle mecca. And again, more money is flowing into it because it's such a good place. It pushes the values up exponentially. And now people with a lot of money are turbo gentrifying prices in Manly at $77,000 a meter. That's crazy. Never thought I would see that. That's more expensive than any square meter rate in Melbourne, Perth, Brisbane, anywhere, just for Manly Beach, which I'm sure most of you listening, if you've come to Sydney, you've probably come to Manly Beach. So blue space, really important. Now, what if you can get blue space for 10,000 a meter, 8,000 a meter? No, you would grab it, right? You would grab it because you know that there's going to be a migration effect of money onto that waterside suburb, that beachside suburb, which is great. And again, you can do that in the city or in the golden arc. So you can do that in a place like Sydney or Melbourne or Brisbane. But in the golden arc, if you have to go further out, you can use what is known as lifestyle geo arbitrage, which is really the idea that you can live and work within 125 kilometers of a major CBD today because of work from home hybrid work. And all of a sudden that creates a green space, blue space effect on places 100 kilometers from the center of the city. But they have the beach, they've got the nice lifestyle. And all of a sudden those geo lifestyle arbitrage suburbs are actually highly prized. And again, you will get a migration of money into those neighborhoods. It'll push up the value. And of course, where we demographically see a migration of money and a lot of money is millennial suburbs, new housing suburbs where 3 and 4 bedroom homes are positioned. Some of them are out as suburbs, but they're going to get a lot of pressure from money. And, you know, in 2026, we've got $100,000 places set aside for first home buyers who are millennials that want 3 and 4 bedroom houses to get a 5% deposit guaranteed by the federal government. So we know the millennial suburbs are going to do very well, where the newer 3 and 4 bedroom properties are, which is great. And really what's always worked well in Australian real estate is those quintessential inner city, middle suburban, inner urban village settings. Like if you live in a village that's 10 Ks from the city, 5 Ks from the city, there's always a good migration effect of money to those places because today people value that walkability concept that they can live a life on foot. And I think you will get more money flowing to those type of pockets. So for me, that's the golden arc of real estate at a localized level. And then, of course, at a more data-centric level of what's going on when it comes to both price delta and sentiment, it's really interesting to see that you will probably see money now migrate from other states which have done very well through the COVID era to Victoria and obviously, namely Melbourne. So I think the best is yet to come for that Melbourne marketplace, which is going to be very exciting for people that own real estate there and have stuck it out for the last couple of years. But equally, there's some value in that market, and now you're starting to see the signs of money coming to that market. You layer that with the golden arc, and you do very, very well using the migration of money strategy. All right, folks, that's it from me. Take care. Talk soon. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.